Hey, how goes it everyone, and welcome back to Dividend Compounders with Cheese. In today's video, we are going to talk about EPR Properties, ticker symbol EPR. They classify themselves as the REIT leader of the experiential properties, a fancy way of saying their portfolio consists of anything and everything entertainment related. So in this video, we are going to look at the intangibles, the finances, and run some valuation models to determine if it's a delicious or a disgusting dividend stock. So this statement right here is worth calling out. A full 74% of Americans now prioritize experiences over products or things. I myself, as being a millennial, can fully resonate with this statement, and it makes a lot of sense. So this is a YouTube channel that is focused on dividend compounders. So let's go ahead and check out their dividend over the years. So it looks like back in 2013, they paid out $3.15 per share. And as of last year, they paid out $3.25 per share. Hold on, that sounds eerie similar, and that's because when we take a look at the history of the dividend payout, whenever there is a financial speed bump or turmoil, they do not hesitate to cut the dividend. And during the pandemic, they even freezed and halted the dividend payout altogether. They slashed their dividend from $4.50 in 2019 down to $1.52. This is a major red flag. With that said, right now the dividend payout ratio is 62%, so it's pretty healthy, it's sustainable, and that's calculated using the AFFO. The dividend yield is actually really juicy. The annual dividend is now $3.30, and as you can see by the dividend payouts, this is a monthly paying dividend stock. However, because it is a REIT, those payouts will be taxed at your income tax bracket. More importantly, I want to know, how has the company performed over the years? So for the past 5 years, EPR has returned 1%. 1%! And you might be like, well, that's unfair because this is a REIT that got hammered during the pandemic. Right before the pending pandemic, they were trading for about $62 a share. Well, the stock price did crash all the way down to $16 a share. Okay, so in 10 years, they returned 75%. That looks a lot better. What about 15 years? And in 15 years, they returned 320%. So it does look like over the long term, EPR, not a bad investment, but in the short term, because of the pandemic and because of the dividend cuts, not a good return on investment. Next, let's go ahead and talk about their business model and if they have an economic moat. Their business model, I think, is pretty simple to understand because it's a REIT. They own the properties in which companies need to operate their operations. So when we look at what kind of properties they have, they're in the eat and play space. So things like Topgolf, bowling centers, they have amusement parks, aquariums, museums, and they have one casino resort, and they have a whole bunch of ski resort properties, gyms, and concert venues. This is the category that they're trying to emphasize and prioritize. Their top client is Topgolf. One of the concerns that I have with EPR is that all of their businesses are wants and not needs, necessities for the consumer. They don't have to go to the movie theater if their budget is tight. They don't have to go skiing in the winter. People don't have to go to the aquarium. That's the issue with discretionary spending. When times are good, people don't hesitate to spend money to enjoy themselves, to go for these experiential moments. But when times are tough, all of EPR's clients are going to be struggling because consumers are not going to be spending. So right now, 39% of their experiential portfolio does consist of the movie theaters, but they are trying to cut back according to their earnings report. This is the sector that they're trying to grow, the eat and play category. And these categories right here, they're trying to grow at a very conservative rate. And this right here, they're trying to get rid of altogether, the private schools and the preschool buildings. As far as I am concerned, they are concentrated and have a small moat around the experiential REIT space, such as indoor skydiving, snowboard resorts, climbing gyms, concert venues, museums, zoos, aquariums. So this is a very specific type of REIT where I imagine whenever there's an economic downturn, every single one of their clients are going to struggle. So it's kind of a risky play in my opinion. It does in fact look like the leisure experiential spending does increase year over year, except during times of a recession period. But the biggest drop off right here was during the pandemic when there was literally a virus going around. So that probably explains why it was a lot more drastic than the other financial turmoil situations. And this is really funny. There's over 72 million millennials in the US, their largest demographic that they're targeting, and they like to prioritize experiences over products. This is actually true. I don't care about what kind of car that I drive. I care more about fostering a memory that my family can look back on. So if you are interested in a REIT, one thing that you want to be mindful of is the occupancy rate. So right now they have 99% of their buildings leased or rented out, with only 1% probably not being rented out due to innovations or they're doing construction on it. All right, I think I've seen enough. Let's go ahead and move on to the next metric, which is going to be the technical indicators to see what the stock price movement has to say about EPR's future. Alrighty, so it does in fact look like the market is very bullish on EPR right now, as their RSI is at a historic high of about 65 to 70. And it looks like as of recently, they have hit a line of resistance, and if they can break through, they could be on pace to hit a new 52-week high. EPR has some green flags and certainly some red flags. So we're going to go ahead and run some valuation models to figure out what the intrinsic value is. So the first one that we're going to do is the multiples valuation. Essentially, we're going to be looking at similar companies in the same industry as EPR to figure out what should be the market value for EPR. And when we take that into consideration by using the AFFO, which is the adjusted funds from operations instead of the PE ratio, because this is a REIT, that gives us a stock price of $77.46. Moving right along is going to be the discounted cash flow analysis model. Essentially, we are going to reach an intrinsic value for EPR based on their free cash flow growth. So it looks like their numbers are a little wonky, and their free cash flow is actually looking pretty nice, except back in 2017. However, it is very inconsistent. Sometimes it goes up by 3 digits, and sometimes it goes down by double digits, as of 2020 and 2022. So that gives us a really wonky number for the average growth rate of 209%. We are not going to plug that number into the formula because that's going to give us an outrageous value. Instead, we are going to play it conservative and go with what the analysts are predicting, which is 15.4%. So when we think about this number alongside with some balance sheet numbers, that gives us a DCF price for EPR, $50.43. Moving right along is going to be the dividend discount model, the DDM. Essentially, we are going to derive an intrinsic value based on the average dividend growth rate. So because they did cut their dividend back in 2020, there is a negative 33% right here affecting its number. So for the past 5 years, the average dividend growth rate is actually negative 5.83. However, if we zoom out and look at the historic dividend growth rate, well then that's 1.5%, and that's what we're going to plug in. This gives us an intrinsic value of $17.29 from the DDM model, which brings us to the conclusion. If you can't tell by my voice and what I'm seeing, I am not really excited about this stock. It does not strike me as something that is undervalued. But anyways, Jimmy, please can you wake up and hit the drums? Ba 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 ba. The intrinsic value for EPR is going to be $48.39. Let's go ahead and see what Wall Street has to say about their price target. Wall Street says that EPR is worth $46.85 per share, with the low prediction of being $40 and a high of $51. It is currently trading for about $48. The stock market is closed on Christmas. We are going to go ahead and assume that it's going to stay at around $48. Wait, hold on. My math is mathing here because we got $48.39 as the intrinsic value, and it's currently trading for about $48.40. We are 1 penny off. That's the closest I've ever gotten with one of these valuation calculations. All right, so Wall Street says 46, we said 48. If you're looking to jump into EPR, which I'm not sure why you would want to unless you're very bullish about the experiential economy going forward, and you're trying to figure out what is the acceptable buy price. With a 10% margin of safety baked in, then you're looking to jump in when the stock price hits $43.55. However, because this is a very risky and cyclical industry REIT, let's say you want a bigger margin of safety baked in, let's say 20%, then you're looking at EPR when it hits $38.71. And when you look at its 52-week range, it did in fact hit $33.92, I'm guessing right here, back in March. So this value is not out of the question. So what is my personal opinion about EPR? Well, I liked what I saw, and that was only going off a face value of the dividend yield being 6.8% and the technical indicators suggesting that the market is bullish with EPR. However, after doing a deep dive and researching and getting to know the company, I do not like it, especially knowing that the company does not hesitate to slash the dividend, especially when times get rough, and how the stock seems to be trading at its intrinsic value of $48. I personally feel like there's better monthly paying companies out there, mainly Income Realty Corporation, ticker symbol O, or even Maine, the BDC, which both I have done videos for. I just don't think EPR is worth my attention. I don't know, you might like it. And so the judgment that I have reached is it's not necessarily a disgusting dividend stock because it looks like they hit their once a decade low, of cutting the dividend and things going bad for them. But in between every 10 years, it does look like EPR does do pretty well. So if you believe in that theory and you believe in the future of EPR, maybe right now is a good time to jump in. EPR had me curious at first, and I'm glad that I did the research and the due diligence to find out. I don't like it. Anyways, this has been another video with dividend compounders with cheese. I'll talk to you next time. Stay safe.